The transaction gets into my tax model very early. If there's anything, I see anything, I have enough time to raise up the issue with the top management.
Joining me to give her perspective on some REIT tax issues is Kelly Xu, Tax Director with Brandywine Realty Trust. Kelly, I wanted to start by talking about prohibited transactions. How do you control the process from the early stage, and what is your strategy if a transaction might be outside the prohibited transaction safe harbor?
I think from a prohibited transaction perspective, it's very important you have a good culture from the top, and then you have your C-suite members are very educated in the tax area, because firsthand when they get a capital market transaction, they would have your tax in mind, then they would involve you very early in the stage. So you have enough time to do all the planning and everything, structuring you need to. And another thing is that I work a lot with our modeling and budgeting team. So the transaction gets into my tax model very early. If there's anything, I see anything, I have enough time to raise up the issue with the top management. And the third thing is when we do, when the transactions went into action and the things, we do for every JV agreements and everything, we have a REIT protection provision in every JV agreement. We also do lockouts of the property couldn't be sold within 2 years, like that. And from an internal control perspective, for every transaction within Brandywine, we are required to have multiple departments sign off before the agreement could be signed.
Can you talk briefly about your experience with state incentives and credits and how they fit into the REIT gross income tests?
So for Brandywine, we develop properties. So we do have some development projects. Sometimes, like if we have a infrastructure, a park, or a metro station that provide a kind of amenities to the public, we do get grants from city or state authorities, and I think there are several PLRs addressing how those should be treated. So sometimes it was some of the PLRs would say it's good for the 95% test. Some others says that's good for the 75%. So we do modeling and a projection on a quarterly basis. So we have enough cushion in either bucket anyway.
What are some key points tax directors must consider in the process of managing state and local tax compliance and exposure?
So in that area, from my personal perspective, I would like to know the overall full picture of the tax exposure and everything. So when I started with Brandywine, I worked with our internal control department. We basically did a full review of every single property, every single level of tax, including like incomes, state, local, gross receipts, sales tax, anything that has tax function involved. Then we would put together inventory. For each type of tax, we would assign a tax owner who's responsible for accrual, reporting, what's the frequency we have to file, and then also where everything is saved. After we establish that inventory and control, then on an ongoing basis, what we do is we would have a checklist to revisit my inventory every time there's a change.